Good morning and welcome back to the Haven Financial Group radio show. I'm Larry Kolbig, founder and CEO of the Haven Financial Group, on with Kyle Thomas, certified financial planner on the Haven team. And Kim, it's our 10-year anniversary again this year. We're very excited. We're approaching that real soon here, and we're expanding. We just added space for the third time in 10 years, so we're very excited to add more staff members. And I'd be remiss to not give a shout out to my wife, who just had a birthday this week, Kim. Mm-hmm. So I had to sneak that in here.
Of course,
I just had to.
You better.
And we're in June now. Can you believe that?
No, I cannot.
I know it. So just needs to slow down a little bit. But if you're listening, feel free to give us a call. 612-504-8400 or havenfinancialgroup.com. All kinds of retirement tools. And there's a lot more tools out there, projection tools and calculators and all that kind of good stuff that you can play around with. So I encourage it. And, especially in these volatile times, have a partner you can lean on. You're going to hear that several times in this show. If you're listening and not getting the attention, ask yourself, why aren't you? If you make a phone call and you don't get a return call, ask yourself, am I in the right place, or maybe I'm not in the right place? So again, I'm going to challenge listeners here a little bit today to pick up the phone and give us a call. We'd love to visit.
Absolutely. Kyle Thomas, of course, with us as well, a certified financial planner there at Haven. And I'm going to have Kyle start this segment out by kind of explaining to everyone, when I was teasing this before we went to the break, I said that in this segment, we'd like to talk about the economy and the markets and how they're different. We can see, Kyle, sometimes the markets go crazy and yet GDP can be lower. So can you explain to our listeners maybe a little bit about the difference?
Yeah, so the stock market and the economy they're actually not correlated all too much. A lot of people think a recession depends on how the stock market is performing, but we could absolutely have a booming stock market, but the economy is not in a great spot. So one of the biggest definitions of a slowdown or a recession for the economy is 2 negative quarters of gross domestic product. And so we had a first one in quarter one of this year. So we'll see, what happens in quarter two. But there are a lot of indicators showing that things are good within the United States with, the job security, that's kind of stayed in line with what the Fed is wanting to keep it at. Because they have the dual mandate with inflation and then also unemployment. Unemployment's in a good spot. They're trying to have inflation get to 2% before doing any kind of rate cuts or anything. Right now, it's at 2.8, or as of last month. So that's a big driver of the economy as well, because companies lend from banks, and that drives what kind of profits they have.
Absolutely. I'm sorry. I was just going to say, let's go back to inflation for just a second, though, and explain to people. I mean, I hear constantly reports about how gas prices are down and it's getting better at the grocery store. We're not paying quite as much for eggs. But yet you've just said inflation is not really where they want it to be.
Yeah, exactly. So it's been high for the last couple of years. It's slowly making its way down, but we're still at a point where it's above where they want it to be. I mean, it's close to 50% higher than where they want it to be before they do any kind of rate cuts. And remember, when rates are cut, that drives the economy. That makes people want to spend money rather than save it, right? And it's going to create more inflation by people spending money, because once there's more demand for things, price goes up and all of that. So some inflation is good too. Not all inflation is bad. We do want inflation, actually. We just don't want it at 8 or 9%, wherever it was a few years ago. We want it at that 2%, because that drives sustainable economic growth without prices going out of control, like how eggs went in the last year.
Larry, it's amazing how quickly it goes up and how slow it comes down.
It always is. Inflation isn't over by any stretch. It's really shifted. You mentioned energy prices and and goods, and then maybe the grocery store and eggs, maybe we've noticed that they've come down, and they have. But if we're talking services or insurance, man,
Right.
insurance is gone through the roof with all the things that have gone on in this world with fires and floods, and insurance is just through the roof, and that's eating away at people's budgets. Housing continues to be extremely high. Mortgage rates have come down a little bit. All these things affect people's budgets, and a budget is so important, especially for retirees. We always preach to the younger generation and when they're young to develop a budget, but most retired Americans are on a fixed income. And if it starts getting eroded by this inflation, which it has been, and depleted savings accounts and so forth, that's where we really see people feeling it and their retirement getting affected. And that's why we like to always say you want a good amount of liquid funds, a good balance between liquidity, stock market investments, and fixed income or principal protected investments. So you can adapt to these volatile times.
Sure. I think what we're proving in this segment of the show is that Wall Street and Main Street are not necessarily directly correlated. I think that's what you guys are saying, correct?
Yeah, that is absolutely correct. And also one thing that to note, sometimes recessions aren't really known about until after they happen.
Mm-hmm.
So there's some cases where we look back after a few months and say, oh, that was a recession.
Right.
And the stock market could absolutely be going bananas at that point. And so they're not correlated at all. The stock market is completely driven off of what the perception is of the tariffs right now. Just like when the announcement for multiple tariff scenarios being delayed or pushed out drove the market up dramatically. That's completely driving it right now, because once we have any kind of sense of security and knowing what's going to happen, the stock market is going to react to that, because it reacted so much going down once they were put on April 2nd, that any kind of good news is going to drive that, not necessarily what the economy is doing, because a lot of economic indicators are actually still good.
So again, uncertainty is really what we're talking about here. And so what are ways that a consumer can take advantage of these times? Where can you put your money? There's got to be some good outcome in all of this.
Yeah, let's face it. You're right. Investors are nervous. They're sitting on a bunch of cash, a record money market of like $7 trillion in money market funds. They're just holding cash and not investing it, and that can be problematic too, because you're missing opportunities. And there's so much volatility, but the market's up this year, so it's not doom and gloom that you hear on every news station in various days. The market has still been strong. Yeah, it's a roller coaster ride, and people have let their emotions take over, just like we're talking about. And maybe they've gone to the sidelines and they've not gotten back in, and they've missed opportunities. And I think of the younger generation. There's a generational divide in the future here. The younger generation worries about retirement. They worried about money. They don't invest like they should. Let's face it, the baby boomer generation and the generation after, they've been very disciplined for the most part and very good at saving, delayed gratification, not racking up those credit cards. And that's where we get to experience a lot of our clients that are very well prepared for retirement. I'm worried about the younger generation. Obviously, we have 4 daughters that are just entering the workforce, but there's a lot of confusion out there, which leads to bad decisions. And if you're younger, you have a long-term opportunity to take advantage of compound returns over 10, 20, 30, 40, 50 years. Don't make the mistakes of getting so worried and caught up in the times. Start saving, develop a plan, and that's where, again, we like to help people in a variety of ways, and it's why our clients over recent years said, "Can you help our kids? Can you help our kids?" We certainly can help your kids. We're not limited to just retirees. You should develop a plan at any age.
Sure.
And if you're not time is of the essence. It really is.
Absolutely. So if you are looking to develop a plan, if you have a lot of questions about the uncertainty in the economy, and if your monies are in the correct place, give them a call at Haven Financial Group. Their number is 612-504-8400. Again, 612-504-8400. You can also check them out at havenfinancialgroup.com. On the other side of the break, tariffs. We'll talk a little bit more about that and how they could impact your retirement. This is the Haven Financial Group radio show.